Hello, I'm Mr. Flawless, a financial trader and a trading coach at Flawless Executions Trading Hub. And if you are yet to subscribe to our channel, please do so by hitting on the subscription button, share our videos, like and comment on them. And this is your free way of you supporting the channel. In my early trading days, my curiosity drove me to search and to research on the reasons behind price action, direction, and movements. And I found out this as one of the driving forces behind price action movements. And this have made me thousands of pips so far in my trading career. And I am here to share with you that particular thing today. Alright, let's go. Hello, welcome back. Mr. Flawless still here, and on this lesson we are going to look at how inflation and interest rates affect the value of a currency. And without wasting my time, let's hit on to today's business. Inflation is defined as the sustained increase in the general price levels of goods and services over a period of time, and it determines the purchasing power of a currency in the sense that high inflation means the purchasing power of a currency is weak, and this implies that you need more of that currency in paying for goods and services. What I just said means that when inflation is high, the purchasing power of that currency is low, and when inflation is low, the purchasing power of that currency is high, in the sense that you need very little amount of that currency in paying for goods and services when inflation is low. And then we move on to the next point. Central banks have inflation targets of 2 to 3% annually. And the central bank that I'm talking about is the banks of nations. And the Bank of Nations that I'm talking of is the Federal Reserve Bank of America, the European Central Bank for the European Zone nations, the Bank of England for the British, the Reserve Bank of New Zealand for the New Zealand people, Bank of Ghana, Bank of Nigeria, and every country have its own central banks that see to its day-to-day adjustment of its monetary policies to suit their economy. And to the next point, the two most useful instruments to measure inflation are the Consumer Price Index, and the Consumer Price Index is a measure that examines the weighted average of prices of a basket of consumer goods and services, such as transportation, food, medical care, and a lot more. And mind you, it is the most frequently used measure of inflation and deflation. Then also you have the retail price index, and the retail price index is an older measure of inflation that is still published because it is used to calculate cost of living and also wage escalation. Then the next point says that it is mandatory for central banks to control inflation via monetary policies to prevent high inflation and also to prevent deflation. And in this sense, government and central bank want just enough inflation in the economy, not too much, which will lead to inflation getting out of hand, and not too little, that will lead to stagnation of inflation below the 2%. And central banks use interest rate cut or rise as a tool in controlling inflation. So this is the two interest rate is the two central banks use in controlling inflation. And in our subsequent slides, we are going to talk about how this is done by the central banks. Interest rate. Interest rate is the rate you are charged on the loan you take from banks, or the returns you expect to receive on your savings or investment. Or if you are a lender, that's the amount you charge on your money you give to a borrower. And in this sense, when the interest rate is high, this means that the amount you'll be expecting to receive on your savings will be also high. Central banks on monetary policies to suit economic well-being will be cutting, rising, or holding interest rate. And at this place, when a central bank is looking to hike or rise interest rates, we say that that central bank is hawkish. And when a central bank is cutting or sending signals that they are about to cut interest rate, we say that that central bank is dovish. Central bank will consider cutting interest rates when the economy is in the contraction, recession, or bust or slump in the business cycle phase. And in these phases, inflation is decreasing because the economy is going down. And my next video will be about the business cycle. So if you do not understand the phases of the business cycle, stay tuned and look forward to my next video. And in these stages of the business cycle, the central banks will normally reduce or cut interest rates so that they can send inflation up as inflation will be decreasing. Then central bank consider rising interest rates when economy is in the late recovery and expansion phase of the business cycle. And at these phases, inflation is normally increasing, and normally inflation will be above the 2% or the 3% mark of these central banks. And this inflation above these marks is not good for the economy, and they will be looking for ways to bring in the inflation down to their preferable 2% or 3% mark by hiking or by increasing rate. Central bank will hold or they will do nothing about interest rate when the inflation is at their intended target or they are satisfied with the inflation. So when inflation is at a mark they are much satisfied with, they do not touch on interest rate because inflation is at their desired levels. Once we've gotten to know what inflation is and also what interest rate is, now we have to know the relationship between these two, inflation and interest rates. And the relationship between inflation and interest rate is simple. Central banks or governments use interest rate cut or hike as a tool in controlling inflation. They use interest rates as a tool in controlling inflation. Let's use the diagram you see on your screen in explaining further the relationship between interest rate and inflation. Interest rate is the one on the y-axis. This place will be interest rate, and on the x-axis will be inflation. And we've said that central bank have the preferable inflation targets of 2% per annum. So when inflation is at this point, this will be the level of interest rate that gain the central bank its inflation target of 2%. So when inflation gets to 4% and central bank's request of bringing inflation back to the 2% mark, they will have to increase interest rate. Interest rate going up will bring inflation down to the 2% mark when inflation was previously above the 2% mark. And also when inflation comes below the 2% mark, let's say 1%, and for central banks to bring inflation back to the 2% mark, they will have to lower interest rate here to bring inflation back to 2% mark here. I have another video that will best explain this concept to you. So let's look at what you see on your screens, and this is what we call the pulley. Our physics student will say, but I'm going to use the pulley in explaining the relationship between inflation and interest rate. And this load here is inflation, and also this load here is the interest rate. And you see this mark here is the preferable 2 to 3% inflation target of central banks. And as you can see from the picture, this inflation is way above the 2% mark. So for this inflation to come back to the preferable 2% mark of central banks, inflation have to rise. You have to push inflation up, and as inflation will be going up, this whole rope will be unwinding to bring inflation down. As interest rate is rising up here, inflation will be also be coming back down, and as soon as inflation hit the 2% mark, they will hold interest rates at that point. And also inversely, when inflation is way below the 2% mark, it's below the 2% mark here, and central banks want to bring inflation back up to the preferable 2% mark, they have to lower, bring interest rates down here. So as interest rates will be coming down, inflation will also be going up. And as soon as inflation get to the preferable level, we central banks will hold interest rates at any level that brought inflation to the preferable levels. As we have understood the relationship between inflation and interest rate, I think this is the time we should move on to know how inflation and interest rate adjustment give value to a currency, how we can use the relationship between inflation and interest rate to know the potential value of a currency to give us our fundamental bias so that we can trade on. Interest rate hike reduce the amount of usable funds in the economic system. And the main reason for central bank to hike inflation is because there are too much funds in the system which they want to get some back into their reserves, and by doing so they have to hike interest rates. And they hike interest rates in order to prevent people from spending and to encourage them to save. And as you are saving, you are not spending because interest rate is high. You will save so that you get higher yields on your investment. And if you spend anyhow and your money got finished, you go to the banks to seek for loans on a very high interest rate, and this will prevent you from spending anyhow. And if citizens are not spending anyhow, they are saving their monies to the banks, spending wisely, and this a lot of goods will be in the system and people will not be interested in buying them. And as these things will the supply of these things will overshadow the demand of it, the inflation of these goods or the prices of these goods will come down. And in normal sense, this will also increase the value of the currency because, as I said earlier, we have to for a currency to have high purchasing power, you have to use little amount of that money in paying for goods and services. And in these instances, the value of goods and services have decreased, and you're going to use a very low amount of this currency in paying for goods and services when interest rate is being hiked, and this will make that currency bullish, or this will make that currency appreciate in value. And also, interest rate hike make an economy lucrative for foreign investors in a sense that all investors want a place where they can have higher yields of their investment. And if a country is having higher interest rate, this will make that economy very lucrative for foreign investors, and these foreign investors are coming to that country with their indigenous currencies, and no country rather will accept an indigenous currency into their system. So these foreign investors have to exchange their indigenous currencies into the that of the US dollars. A lot of investors will be doing so, and by them changing their currency into the US dollar will increase the demand for the US dollar, and anything that gets high demand will increase in value, and this will also give a knock on the head appreciation to the United States dollar. The United States dollar will start appreciating from henceforth. So these 2 points will show that the currency in this economy will increase. Now let's look at the other way around. When interest rate is cut, indicates that central banks want the amount of usable funds in the system to increase. And if this usable funds in the system increase, a lot of people will have excess money in their pocket and they're going to spend it anyhow on anything, and this will increase the demand on goods and services. And if the demand on goods and services increase, their price will also increase, and this will bring about inflation that we've talked of earlier. And when inflation is higher, the purchasing power of that currency is lower because you need a lot of that currency in paying for goods and services, and this will depreciate the currency. And also, low interest rates devalues the currency in the sense that it does not invite any foreign investors into the economy, and the demand for the currency will not be that high. And if the demand is not high, the price and the supply is high, the price will always go low. So this point above also shows that when these 2 points happens in an economy, it brings their currency down. And in a nutshell, putting all these things together, you have to buy a currency with high interest rates and sell a currency with low interest rates comparatively. And as forex is being traded in pairs, you have to look for currency with high interest rates against a currency with lower interest rates. And with this pair, we have to buy the currency with high interest rates against the currency with low interest rates. And this is not only the thing that we depend on in calculating the strength or weakness of a currency. But as a first step, please just put it at the back of your mind, and things are not that simple as you see. Thank you for being with me all this while. And please, if you've not subscribed to our channel yet, please do so and also hit on the notification button. See you soon with the business cycle videos next.